On Monday evening, October 28, 1929, Charles Mitchell walked back into 55 Wall Street with the most expensive smile in America. The market had just fallen by a terrifying amount. Not a normal bad day. Not a rough afternoon. A collapse so violent that the financial district had begun watching faces instead of prices. The traders outside watched Mitchell because he was not just another banker. He was chairman of National City Bank, the largest bank in the United States, a man the press called Sunshine Charlie, and one of the loudest believers in the idea that American finance could be made bigger, broader, and more democratic. He had spent the afternoon at the Federal Reserve Bank of New York, trying to solve a panic in public while another panic formed in private. A month earlier, Mitchell had been arranging to make National City even larger by absorbing Corn Exchange Bank. The deal depended on confidence in National City stock. Now confidence was the one product Wall Street could no longer manufacture. When Mitchell learned how much National City stock had been taken onto the bank's books that day, the scale of the danger landed at once. The bank did not have unlimited cash. Its prestige did not make arithmetic disappear. The institution he had built as a machine of optimism suddenly looked like something more fragile, a balance sheet filled with assumptions. This episode is about how America arrived at that room. Not the crash itself. Not yet. Before panic became obvious, it had spent months wearing better clothes. It appeared in private offices, hotel dining rooms, radio studios, Senate letters, investment plans, brokerage windows, and the thin strip of paper that told Americans the future had a price. The question for episode 1 is simple: how did speculation become ordinary life? To answer that, we begin months earlier, with a man who understood better than almost anyone that the market was not only numbers. It was emotion wearing a hat. That architecture is built from incentives, from institutions that seem rational in isolation. A bank expands credit because customers want opportunity and competitors are doing the same. A broker offers margin because customers demand access and rising prices make the risk feel manageable. A regulator hesitates because a clumsy warning can trigger the very crisis it is meant to prevent. A politician denounces gambling because capital appears to be leaving farms and factories for Wall Street. A speculator borrows because every month of rising prices makes debt look like intelligence. None of these decisions requires a villain. That is what makes the story harder and more useful. A bubble is not a bank robbery. It is a social arrangement in which the benefit of continuing is immediate, private, and measurable, while the cost of stopping seems theoretical, public, and easy to postpone. That is why this episode begins before October. We will not yet ask why the market crashed. We will ask why it became so hard to imagine that it could. The crash will come later. First comes the seduction. On March 4, 1929, Herbert Hoover became President of the United States. He entered office with almost impossible confidence around him. The press had largely celebrated his election. He had business credentials, engineering discipline, and a reputation for competence. He had made his own fortune before government, then built a public career as a manager of emergencies. But Wall Street did not quite know what to make of him. Hoover believed the economy could be managed. He was not a simple do-nothing heir to Coolidge. He was an engineer with a pencil, a pad, and a belief that systems could be improved by intelligent coordination. That made some financiers uneasy. To reassure business, Hoover kept Andrew Mellon at Treasury. Mellon came from Pittsburgh industry and believed that buying and selling securities were private matters. If Americans wanted to speculate, Washington did not need to act as referee. Under Mellon, the tax treatment of capital gains had become more favorable to investors. Hoover worried about speculation. Mellon preferred restraint in government intervention. The Federal Reserve argued with itself about credit. Wall Street wanted the freedom to keep lending. The early months of 1929 reveal a government trying to avoid two humiliations at once: act too sharply, and Washington might be blamed for killing prosperity; act too softly, and Washington might be blamed for letting speculation metastasize. This is how bubbles paralyze authority. They make every intervention look like the possible cause of the crash, right up until non-intervention becomes part of the cause. 10 days earlier, Charles Mitchell had attended a meeting at the Federal Reserve Bank of New York. He had recently joined its board, a mark of trust and status, and also a compromise. The New York Fed's late governor, Benjamin Strong, had understood that Mitchell could be useful inside the room and dangerous outside it. Mitchell had spent years building National City into something more than an old bank. He wanted a modern financial services empire, what he called the bank for all. That meant deposits, securities, loans, and ordinary customers. He did not want Wall Street to remain a club for insiders. He wanted average Americans brought into the machine. To Mitchell, credit was not a moral failing. Americans already used installment loans to buy radios, refrigerators, and automobiles. Why should stock be different? If modern corporations represented the future, then lending against their shares seemed, to him, like lending against progress itself. The risk is that democratization can hide extraction. A bank can broaden access and deepen dependence at the same time. A customer can feel newly included while becoming newly exposed. Mitchell's vision made finance more available, but it also normalized the idea that ordinary household balance sheets should be connected to market prices. Once a household begins measuring itself against the market enters the home. A wage is no longer the only source of progress. A savings account is no longer the only proof of prudence. The paper gain becomes part of dinner conversation, part of status, part of future planning. The Federal Reserve was young, barely 15 years old, and divided by design. It had regional banks, a board in Washington, and a constant tension between local financial power and national public responsibility. By early 1929, the board had become alarmed that Federal Reserve credit was indirectly feeding stock speculation. Money meant to support commerce and production was flowing into brokers' loans and margin accounts. This was not a simple choice between wisdom and foolishness. Raising rates might slow the real economy. Doing nothing might let speculation grow larger and more dangerous. Direct pressure might cut credit to the market, but it could also trigger exactly the panic it was meant to prevent. Every policy path had a trapdoor. A Federal Reserve statement could become prudence in Washington, threat in New York, and panic in the branch office. Mitchell believed he understood that translation better than the policymakers did. From his desk, the Fed's restraint did not look like careful surgery. It looked like pressure applied to a crowded theater. 2 days after Mitchell's meeting at the New York Fed, he called William Crapo Durant in Flint, Michigan. Durant had founded General Motors, lost control of it, returned, lost control again, and reinvented himself as one of the most visible speculators in America. The stock market was not a side interest for him. It was the great stage on which American enterprise proved itself. Mitchell and Durant shared a grievance: the Federal Reserve. They believed Washington did not understand the market and that efforts to restrict credit could cause the very disaster the Fed feared. Durant pushed the argument further. If investors could not borrow against good American securities, then credit would tighten not only for speculators but for the whole web of business: cotton planters, farmers, merchants, manufacturers. The argument had power because it was not wholly false. The danger had power because it was not wholly true. Durant's genius as a salesman was that he could make self-interest sound like national interest, because, in an economy built on credit, the two were genuinely tangled. The day after Hoover's inauguration, a small group of Wall Street reporters arrived at the Heckscher Building, not Wall Street, but Midtown, 5th Avenue, and 57th Street. They had been invited by Jesse Livermore, one of the most famous speculators in America and one of the least available men in finance. Wall Street had called him the Boy Plunger, a nickname that made him sound younger and wilder than he was. By 1929 he was 51, still lean, still watchful, and far more private. Years earlier, the pressure of public notoriety had driven him away from the noise of the financial district into a custom-built Midtown headquarters. The reporters had heard stories about the place. Few outsiders had seen it. The building staff were under instructions to deny that Livermore's office even existed. His operation looked like a private exchange. Dozens of phone lines. Telegraph machines. A chalkboard large enough to turn prices into weather. It was a place built for watching the market breathe. And yet the subject Livermore had called the reporters to discuss was not the stock market. He spoke about cotton. Imagine being allowed inside one of the most secretive trading rooms in New York, only to discover that the Great Bear of Wall Street has invited you to discuss a commodity most stock speculators were not thinking about that morning. But the apparent anticlimax is exactly what makes the scene valuable. Livermore understood attention. He knew reporters would write not only what he said, but the fact that he had allowed them into the room. The office, the private elevator, the clerks, the tickers under glass, all of it performed authority. He did not need to shout. The room shouted for him. And still, when the reporters wanted his view on the stock market, he withheld it. In a market where everyone was being invited to have an opinion, the most famous speculator in the room kept the most valuable opinion out of print. That restraint is one of the first clues to the real story. Livermore's reputation came from a trade most Americans found almost morally backward: short selling. Most investors buy first and hope to sell later at a higher price. A short seller reverses the order. He borrows shares, sells them immediately, waits for the price to fall, buys them back cheaper, returns what he borrowed, and keeps the difference. The important word is borrowed. A short seller creates an obligation. If the price falls, that obligation becomes easier to satisfy. If the price rises, the obligation becomes heavier, and there is no natural limit to how heavy it can get. To short a market in love with itself is to stand in front of a parade and insist the street is about to end. Livermore had done it before. He had made and lost fortunes. He had learned that being early can be almost the same as being wrong. A bubble can punish intelligence longer than most people can fund conviction. The real Livermore move came later. By Sunday, March 24th, the market had become jittery. The Federal Reserve was trying to restrain speculation. Traders were waiting to see what Washington would do. The next morning, March 25th, Livermore prepared to act. His traders gathered before the market opened. The order was simple in spirit and enormous in scale: sell short. By the end of the day, the position was vast. Livermore had pressed his capital and credit to the edge. If the market rose, he could be ruined. If it fell, he could make a fortune in hours. The next day, March 26th, the market fell, sharply enough to make Wall Street feel the floor move. But the bigger story was not simply that one speculator made money. It was that the market was now so leveraged, so dependent on credit, that a drop could become a mechanical event. Selling pushed prices down. Falling prices triggered calls for more cash. Demands for cash forced more selling. The machine had human parts, but it was issuing commands.